What if I told you that you could turn a simple $500 a month into a $1 million investment portfolio? It sounds crazy, right? But the truth is, it's not about luck, it's about strategy. It's about understanding how to make your money work for you, how to leverage the power of compounding, and how to build wealth strategically. In this video, I'm going to break down the exact steps you can take to reach a $1 million portfolio, even if you're starting from scratch. We're talking about proven investment strategies, tax advantages that most people overlook, and even how to incorporate real estate into your portfolio for maximum growth. And make sure you stick around until the end, because I'm going to reveal a secret strategy that high net worth individuals use to grow their wealth 10 times faster than the average person. You don't want to miss this. Alright, let's get right into it. The first step to building a $1 million portfolio is laying a solid foundation, and that foundation starts with index funds and ETFs. Now you might be thinking, index funds? That sounds boring. But trust me, boring is good when it comes to long-term sustainable growth. Think of index funds like the all-star team of the investing world. They track a broad market index like the S&P 500, which means you're investing in a diversified basket of the 500 largest companies in the US. This diversification is key because it spreads your risk and protects you from the volatility of individual stocks. Now, why are index funds so powerful? It all comes down to their low fees and consistent returns. When you invest in an index fund, you're essentially hitching your wagon to the overall performance of the market. And historically, the market has always gone up over the long term. Let me give you an example. If you were to invest just $500 a month into an S&P 500 index fund like the Vanguard S&P 500 ETF, VEO, or the Fidelity Zero Large Cap Index Fund, FNILX, and you earned an average annual return of 8%, guess what? In 30 years, you'd have over $1 million. That's the power of compounding in action. But it's not just about the S&P 500. There are index funds and ETFs for every sector of the market, from technology to healthcare to real estate, so you can diversify your portfolio even further and tailor it to your specific investment goals. Remember, building wealth is a marathon, not a sprint. And index funds are the perfect vehicle for steady, long-term growth. They're like the tortoise in the race, slow and steady, but they always win in the end. Now, once you've got your foundation set with index funds, it's time to start thinking about generating some passive income. And that's where high-yield dividend stocks come in. Dividend stocks are like the gift that keeps on giving. They're shares of companies that pay out a portion of their profits to shareholders, typically on a quarterly basis. So, not only do you benefit from the potential growth of the stock price, but you also receive a steady stream of passive income in the form of dividends. Think of it like owning a rental property. You collect rent checks every month, even if the value of the property doesn't change. Dividend stocks work in a similar way. You receive dividend payments even if the stock price stays flat. Now, when I talk about high-yield dividend stocks, I'm talking about companies that have a long history of paying out consistent and increasing dividends. These are typically well-established, blue-chip companies with strong financials and a proven track record of profitability. Some examples of high-yield dividend stocks include Coca-Cola, KO, Procter & Gamble, PG, and Realty Income, O. These companies have been paying dividends for decades and have consistently increased their payouts over time. Imagine having a portfolio of dividend stocks that generates $4,000 to $5,000 per year in passive income. That's like getting a pay raise without having to work any extra hours. And the best part is, as you reinvest those dividends, your portfolio will continue to grow and generate even more passive income over time. Investing in high-yield dividend stocks is a fantastic way to supplement your income, build wealth over the long term, and achieve financial freedom. So make sure to add this powerful strategy to your investment arsenal. Alright, let's talk about taxes. I know, not the most exciting topic. But trust me, this is important stuff, especially when it comes to building wealth. You see, wealthy people understand that it's not just about how much money you make, it's about how much money you keep. And one of the best ways to keep more of your hard-earned cash is to take advantage of tax-advantaged accounts. Now, depending on where you live in the world, you'll have access to different types of tax-advantaged accounts. In the US, we have things like 401(k)s, Roth IRAs, and HSAs. In Australia, you have superannuation. These accounts are designed to help you save for retirement and other financial goals while minimizing your tax burden. Let's start with 401 KAs. This is a retirement savings plan that's sponsored by your employer. The beauty of a 401k is that your contributions are made pre-tax, which means you don't pay taxes on that money until you withdraw it in retirement. Plus, many employers offer a matching contribution, which is essentially free money. It's like getting a bonus just for saving for your future. Next up, we have Roth IRAs. These are individual retirement accounts that offer tax-free withdrawals in retirement. With a Roth IRA, you contribute after-tax dollars, meaning you pay taxes up front. But here's the kicker. When you retire and start taking distributions, you won't owe any taxes on those withdrawals. It's like a golden ticket to tax-free retirement income. Now, if you're self-employed or have a high-deductible health plan, you might also be eligible for an HSA or health savings account. HSAs offer a triple tax advantage. Contributions are tax-deductible, earnings grow tax-free, and withdrawals are tax-free when used for qualified medical expenses. It's like a trifecta of tax savings. And for our friends down under in Australia, you have superannuation, or super for short. Super is a retirement savings plan that's mandatory for most Australian workers. Your employer contributes a percentage of your salary into your super account, and you can also make voluntary contributions. The great thing about super is that contributions are taxed at a lower rate than your marginal tax rate, and earnings are also taxed at a concessional rate. The key takeaway here is this: don't overlook the power of tax-advantaged accounts. They can make a significant difference in your long-term wealth-building journey. So, do your research, talk to a financial advisor, and start maximizing your tax savings today. Now let's talk about real estate. When it comes to building wealth, real estate can be a powerful tool. It's a tangible asset that has the potential to generate both passive income and appreciation. And when you combine real estate with your stock portfolio, you create a diversified investment strategy that can accelerate your path to $1 million. One of the best ways to invest in real estate is through rental properties. By owning rental properties, you become a landlord collecting rent checks every month from your tenants. This rental income can provide a steady stream of passive income that can help you achieve financial freedom. But the benefits of owning rental properties don't stop there. Over time, real estate tends to appreciate in value. As demand for housing increases and inflation pushes prices higher, the value of your rental properties can grow significantly. This appreciation can create substantial wealth over the long term. Now, I know what you're thinking. Real estate investing sounds complicated and expensive, and while it's true that real estate investing does require capital and due diligence, it's more attainable than you might think. There are strategies you can use to get started with real estate investing, even if you don't have a lot of cash up front. For example, you can look into house hacking, where you live in one unit of a multifamily property and rent out the other units to cover your mortgage. Or, you can explore partnerships with other investors to pool your resources together. When it comes to choosing rental properties, location is key. Look for properties in growing markets with strong rental demand. Think about areas with a thriving job market, good schools, and a desirable quality of life. These factors will attract tenants and drive up property values. Investing in real estate can be a fantastic way to diversify your portfolio, generate passive income, and build long-term wealth. So, don't be afraid to explore the world of real estate investing and see how it can help you reach your financial goals. Alright, we've covered a lot of ground today, from index funds to dividend stocks to real estate. But here's the thing, none of these strategies will matter if you're not consistently investing a significant portion of your income. The more you invest, the faster you'll reach your financial goals, including that $1 million portfolio. So how much should you be investing? A good rule of thumb is to follow the 50-30-20 budget. This budgeting method suggests allocating 50% of your after-tax income to your needs, 30% to your wants, and 20% to your savings and investments. Let's break it down. Your needs are your essential expenses, like housing, food, transportation, and utilities. These are the things you absolutely need to survive and maintain your current lifestyle. Your wants are the things that make life more enjoyable but aren't strictly necessary. This includes things like dining out, entertainment, travel, and hobbies. It's important to budget for your wants so you can enjoy life, but you don't want to overspend in this area. And finally, your savings and investments are the key to building wealth and securing your financial future. This includes contributions to your retirement accounts, investment accounts, and any other savings goals you may have. Now, I know that saving and investing 20% of your income might seem like a lot, especially if you're just starting out. But here's the thing, it's all about priorities. If you're serious about building wealth, you need to make saving and investing a top priority in your life. Start by tracking your expenses for a month or two to get a clear picture of where your money is going. Then, look for areas where you can cut back on unnecessary spending. You might be surprised at how much money you can free up by making small changes to your lifestyle. And remember, even if you can't save and invest 20% right away, start with whatever you can afford. Even if it's just $50 or $100 a month, the important thing is to develop the habit of saving and investing consistently. So there you have it, the roadmap to building $1 million investment portfolio. Remember, it's not about hitting the lottery or getting lucky in the stock market. It's about making smart, strategic decisions with your money and letting the power of compounding work its magic. If you start today, stay consistent with your investments, and follow the steps we've outlined in this video, you can achieve financial freedom and reach your financial goals faster than you ever thought possible. It's time to take control of your financial future and start building the life you've always dreamed of. Don't forget to subscribe to the channel for more wealth-building tips and strategies, and I'll see you in the next video.